Well, good morning, everyone. My name's Tom Bayer. I'm a partner with Sikich in the Indianapolis office. I'm actually in Champaign, Illinois today. Thought I'd come over here and escort the future Big Ten tournament champions over to Indianapolis tonight to start their tournament journey this Friday. And I'm joined by my friend and colleague, Jim Brandenburg. Jim, good morning.
Morning, Tom. It's nice you're down in Champaign. I'm up here in chilly Wisconsin. Also going to be journeying down to Indianapolis this weekend for the Big Ten tournament there, so it'll be exciting.
Good. A couple housekeeping items here, and then we'll get started with our webinar today titled Tax Legislation to Expect in 2022. So again, for those of you who may have joined us before, encourage you to submit questions in the question feature on the webinar control panel. If we can't get to all the questions, we'll follow up with you after the webinar. There will be some poll questions throughout the webinar. Please complete those in order to, for those of you who want to get CPE credit for attending the presentation, please complete those poll questions. The presentation slides can be downloaded from the handout section of the webinar control panel, so look for those. And then, of course, as I said at the conclusion of the webinar, you need to complete the survey as well to get CPE credit. And so we'll get you certificates within 2 to 3 weeks after the program. So with that, let's go ahead and get started. Let me see if I can get my, there we go. So today, what we're going to talk about are, we have several topics we'd like to talk about. We're going to revisit Build Back Better, and you'll see that it's there's maybe some renaming of that as we go along. Talk about proposals for additional COVID relief and energy provisions, extender items from the Tax Cut and Jobs Act and kind of the status of those. Secure 2.0 is a hot topic right now as well, with retirement plans and some changes being proposed. And then just some general other developments with some various tax planning issues that we think are important to present. So with that, I will turn it over to Jim to talk about where we're at with Build Back Better. Jim?
Good. Thank you, Tom, and good morning, everyone. What we're going to start with, again, looking at 2022 is again sort of continuation of where 2021 ended up. And again, Build Back Better was one of the major pieces of legislation that Congress worked through really from the summer all the way through the end of the calendar year last year. So what we're going to look at is, again, where that started last year, where it really stood at the end of the year, where we stand now here as we go into 2022, and then what's perhaps an outlook with that legislation as we move into 2022. Okay, again, briefly, and again, we've covered this, as Tom mentioned before. We had several sessions on this Build Back Better, so just give you a highlight. Again, this was a separate from the infrastructure package that Congress passed last fall. This was a Build Back Better, which was more of an individual infrastructure, social programs they had in there for families, climate change, some healthcare items, some other jobs programs. Again, a number of items that were contained in that initial Build Back Better that the administration and Congress had. Again, it started out at 3.5 trillion, was later trimmed down to about half of that, about 1.8 trillion dollars. One of the key things with this Build Back Better, which continues even as we look at some of the latest developments, is some of the politics behind it. This is a partisan bill with it, and it's being moved under what they call the reconciliation rules. So the Democrat Party in control in the Congress, in both the Senate and the House, they're going to push this bill without any input or support from Republicans. And under reconciliation, what they're able to do is pass it not only with a majority vote in the House, but in the Senate, they just need a majority of 50 votes, not the normal 60 votes that's needed with most of the legislation. With the split being 50-50, however, they can not have any defections. They can't have any senators who don't support the bill. So And there's been two key Democratic senators, Manchin of West Virginia and Sinema of Arizona, who've been outspoken about the BBB and have led to some changes in it. We'll talk about that as we move forward. But again, it's important to get this this background as this legislation moves forward. Again, one of the things we started with it again, with all these initial social initiatives they have, what was the initial plan was higher taxes were going to help pay for it. And again, it was going to be higher corporate taxes, individual taxes, capital gains, state changes, some IRS enforcement measures. But the goal with all these tax increases was to have anybody earning more than $400,000 pay for it. Anybody less than $400,000 would not have any tax change with it. That's what the stated goal was initially with it. So moving on with it, here's what happened with it. Again, the House Ways and Means Committee moved and passed it out of committee in the middle of September. So they were moving forward with it. But again, as they were trying to get this bill that would pass not only the House but in the Senate, they were having trouble, especially with some of the the senators, and the Senator Sinema was not in favor of the higher taxes on individuals and corporations. So at the end of October, they issued what they call a framework, where they really rewrote the whole bill with it. Even though it already passed the committee, it had not gone through the full House. They made some major changes to it. We'll briefly mention those in a moment. Then they made some slight tweaks on it in the first part of November with it. Again, their whole idea was striving to make sure they'd get enough votes to get it through the House and the Senate was their plan. But it was that major rewrite, that the one that was at the end of October, that had caused a number of changes with it. And we'll talk on those in a moment here. Next slide here, Tom. What they changed with it, so instead of having some of the individual and corporate rates, what they did is they would impose a new corporate alternative minimum tax of 15%, a number of foreign changes. The net investment tax, the Medicare tax for individuals would be expanded for individuals over 400,000 or 500,000 for married couple. Then they would have a surcharge on high income taxpayers, again, a 5% for those with income over 10 million and another 3% for income over $25 million. And then last, they would have a SALT deduction, the state and local tax deduction, which again has been an issue within Congress over the last couple of years for state and local tax deduction, which has been set at $10,000. They would increase that to $80,000 up through 2030, and then it would drop down to $10,000. So that was that's what the changes they were going to do. But it's important to note what was taken out of the in this framework, what they took out of it. And just recall this, that the higher tax rates that they had passed initially with that House Ways and Means, those were removed. Higher capital gain taxes were taken out. Higher corporate taxes were taken out. The estate exemption wasn't changed, and grantor trusts weren't changed. So these were all items that were in the initial House Ways and Means version, but were taken out as they this framework as they moved the bill through the House last fall. Then what ended up, last fall with it, the House finally passed this Build Back Better just before Thanksgiving last year, and the Senate was going to take it up after Thanksgiving, and they were hopeful to try to get that done before they recessed for the year around Christmas. But the legislation stalled in the Senate. They knew they were going to have to make some changes to the bill in the Senate. Then major development just before Christmas, Senator Manchin, who we talked about before, indicated that he would not support the BBB. Before, he had some comments about it, some reservations he had, but had not indicated one way or the other where he stood. Finally announced that he would not support the bill, and that really took the wind out of the sail for this BBB, because they realized at that point that they didn't have enough votes to pass the BBB as it stood right at that point. Then they broke for the holidays and came back in the new year here. So where do we stand now with it? With this Build Back Better, the chances for BBB passage have slipped quite a bit. Again, with Manchin's opposition to it, so there hasn't been too much activity here in January and February. The administration, however, has not given up hope. Just in the last week or so, they're going to rebrand it, as Tom mentioned before, maybe relaunch it, and they're going to drop the Build Back Better. Maybe they've mentioned Building a Better America, or something else that they may have, as they're trying to come up with coin another phrase for it. Similar goals though, but it will scale it back in some manner. Again, some social programs, some energy initiatives, again, paid for with some higher taxes. Again, they haven't spelled out what those taxes may be. Next, then just within the last week or so, Senator Manchin indicated, that he is willing to talk on the BBB, but these talks haven't started yet. He'd be willing to undo much of the some of the Tax Cuts and Jobs Act, some of the individual and corporate cuts from a couple years ago. He'd be entertained undoing some of those tax cuts, and it would be used for some energy initiatives, curbing some healthcare costs, and perhaps also some deficit reduction. Those were some goals that Manchin stated he'd like to see. It would likely involve some significant changes in the bill that passed the House last fall with it. However, again, with Manchin making those changes, they might, get him on board with supporting a bill. But if they do bring out some higher individual or corporate taxes, they might lose the support of Senator Sinema, who has been opposed to some of those higher tax rates. So again, they might pick up one senator, but perhaps lose another one. There could be some others who object to some of the other changes in there. Could be some House members who don't like it. Congressional leaders are encouraged that at least they're talking on a new plan, but with 2022 being an election year, again, it just adds a lot to the dialogue as to what may happen here. So let's go to the next one. So what's our outlook for 2022? Again, the leaders are encouraged that at least they've got a plan, at least they're talking. Again, until the last week or two, there was no even plans to have any discussion with it. While this Build Back Better is still on the table, Congress, again, as you know and have seen, has other priorities they're dealing with. They got some world events with the conflict and war in the Ukraine. The federal omnibus bill, again, we'll talk about that here as we go through this session today, needs to be passed by this Friday, or we'll have a government shutdown. And they have a Supreme Court nominee. So some of these priorities are going to take a lot of time, both in the House and the Senate. So this Build Back Better, they still may work on, but it's not, on the front burner, if you will. There's also an unstable economy now with inflation higher. May make the passage of this bill a little more challenging. And again, the further you get going down the year here, it may make it more difficult to pass this, especially again as they move toward the fall elections with it. That makes the issues with it a little bit more involved. So we'll have to see how that plays out this year. But again, at least congressional leaders are encouraged that at least they're talking, and to try to save face, they'll try to craft any bill that they feel that they can get enough votes to pass through the House and the Senate. They will try to do that. So I think the prospects are still, I'd say probably less than 50-50, but they are higher than they were, earlier, in January and February, where there were no discussions at all going on. So that's the latest on Build Back Better. And again, if they do get to a point where they get an agreement with Senator Manchin and something that they might present and have a vote on, obviously we'll get the details out to you on that and have another update session on that.
Okay, so I think we've got our first poll question here. So Jim, you want to read that?
Sure. Okay, our first polling question here this morning. Do you think a revised or scaled back version of the Build Back Better will be passed by Congress this year? So we've got a couple of options, yes, no, or I don't know, your choices here. We can't come up with another choice here, right? There's not a maybe
right.
Yet, I guess maybe.
A definite maybe, yeah, right. So are we going to go ahead and close the poll and show the results?
Yeah, we'll close the poll here momentarily here. Okay, good. Our results here, no, we've got, it looks like about a 2-to-1 lead with no on that. So again, we'll see what plays out with it. And again, as we mentioned with it, this Build Back Better was really almost dead in the water here, after Senator Manchin's comments with it. They've rekindled some hope with it. Again, they have a long way to go with it. And again, as I mentioned, even if they get him on board, it's like a Rubik's Cube because, one thing that he might like, there might be 1 or 2 other senators or members in the Congress who don't like it. And with those narrow margins, it's going to make it difficult to pass with it. The other thing that we briefly talked on, one thing to note too, is the SALT deduction. Even if they come to an agreement on some of the provisions, they'll need to get an agreement on the SALT deduction that they've talked about. Some members want it to go at 80,000. Some, think that's too high with it. And but if there's nothing in there, there's a number of members in the House who won't vote for a final Build Back Better unless there's changes with the SALT deduction. So that will also be a complicating factor. But again, something we're going to keep our eyes on with it. I'd like to turn now to our next section here is some additional relief for COVID that Congress is looking at here now. And Tom will go ahead with that now.
Thanks, Jim. There seems to be some continued interest for an additional relief package. And, as we know, over $5 trillion with a T in relief legislation passed over the last 2 years, and those dollars sort of trickled down into the economy through the PPP Draw 1 and Draw 2, and then of course the Employee Retention Credit has been a very widely used program, and then a lot of other stimulus programs to provide healthcare support for healthcare and for local and state governments. So all of that being said, there's some interest in doing more. And relief for individuals, for businesses, healthcare workers, and students. Obviously, that was part of the first, 3 or 4 packages that were passed. So the administration right now is seeking additional funds for, more healthcare related stuff, medications, vaccines, and other measures, because the funding is running low. There isn't really a wave of bipartisan support to provide additional COVID relief. There has been some compromise in this recent omnibus bill, which may in fact pass today, or at least within the next week, may pass, which is to help keep government open, basically. So in terms of what relief is being discussed, it's the industries that have suffered more than others. It's those the sort of retail industries where during the height of COVID, traffic, customer traffic was down. It's venues, right? We had the SVOG grant. We talk about that. It's health. It's gyms like an LA Fitness. It's restaurants. There was even talk specifically about some of these, minor league sports teams, right? Because they didn't have the fan base coming, just out of the interest of safety. So they're somewhat targeted certain industries, including restaurants, of course, that continue to be affected by the COVID height of COVID, throughout the fall and winter. So there's also proposals again to adopt additional PPP loans, or these restaurant revitalization grants, or SVOG grants, that were popular, and I think both of those, the RRG and the SVOG grants, were those programs depleted every dollar that was appropriated to them. So they were certainly well used. So there was a push in this omnibus bill for an additional $50 billion in relief, but this sort of fell apart over the weekend, including some other tax provisions, by the way, that were there was some suggestion we may see some tax provisions in this budget bill that, like I said, is going to probably be passed in the next maybe today, or at least within the week. So additional relief will be proposed, but support for this, of course, may fade as the COVID cases decline. There are other maybe more critical pieces of legislation that may take precedent over these. So, prospects for this are probably pretty low at this point, although again, there are certain industries that continue to lobby Congress to get some additional relief. You know, what I'll say about the employee retention credit is, you know, I think it has gained some popularity as a tool in Congress, and so I don't think we're going to see this go away. I think that we're going to see this employee retention credit concept continue to come back over time as an industry is impacted. Maybe it's something other than COVID where that industry is impacted, to sort of provide relief to that industry to retain employees, right? Effectively maybe supplanting the unemployment line, if you will. If we can keep employees working, provide some credit to those businesses who are making that sacrifice to help them sort of subsidize the loss in, you know, as we know, employee retention credit, you know, one of the ways you qualified for that in 2020 and 2021 was through a reduction in gross receipts. The rules were different for each of those programs, but I think that will continue to be a program that we'll see as a way to provide relief. And you know, it does have a lot of support in Congress, and it could be reestablished. And again, it could be based on different criteria, right? It could be, you know, the percentages of revenue drop. I would expect that there will be a different threshold in a new proposal. So there was a strong push to include this in the omnibus bill, but it was in fact left out. So, you know, what we're talking about here probably is sort of another piece of legislation where some of these tax provisions may find their way into that legislation. There, you know, there are some, you know, there are some concepts, in ERC being one of them, that have some support. And I think if there was a tax bill, a scaled down BBB, I think we would see ERC potentially be a part of that. So, you know, is some relief possible? Sure, it is. You know, most of it we know. You know, I think that the less controversial relief package would be directed, you know, toward medications and medical supplies and all the things that help either preventative or treatment. It's probably unlikely that broader relief will be adopted. You know, we're in this inflationary period, and you know, there seems to be a bigger push to how do we get control. Gas prices are at an all-time high, and inflation is really you know, ramped up, and so some of these stimuluses may fall by the wayside because of that. However, if there is relief legislation, we believe that it's got to happen within the next month or two, as we get closer to the midterm election, and you've got, you know, of course, the Supreme Court nominee that's going to go through the Senate process. So lots of other, and then, you know, obviously Ukraine and the tragedy that's going on in Ukraine, and there's other more important priorities that are gathering congressional attention. The other piece that seems to have somewhat, you know, Democratic support. It's not across the board. There were proposals last year that would get rid of some of the energy credits and some of the subsidies, if you will. They were outnumbered, though, by mostly proposals to really enhance some of these credits. So expansion of, you know, the credit for carbon sequestration. We're seeing more and more interest in how do we reduce our carbon signature, our carbon footprint, and so the expansion of this under Code Section 45Q would actually reduce the minimums for the metric tons that would qualify you for that. So extension of the Section 48 energy credit was also proposed in BBB. We continue to see, that being discussed as part of a piece of legislation. We might see, credits for renewable fuels or investments in green technology to replace, fossil fuel consumption. Hydrogen, wind, solar, biofuels, all of those, renewable energies are certainly garnering attention, trying to incentivize, energy companies, manufacturers, agricultural producers to really be more, conscious of their usage of fossil fuels and reducing their carbon footprint. So, expansion of credits for electric vehicle purchases, that was part of the BBB as well. And I still believe that there's going to be some real push. And remember that the infrastructure bill that was passed, there's going to be a lot of money spent on these charging stations, right, over time. So the infrastructure, there's dollars going into the infrastructure to really try to build that up to have more people use electric vehicles. So these could be part of a revamped BBB or maybe in some sort of scaled down legislation. So I will turn it back over to Jim to talk about some of the extender items from the Tax Cuts and Jobs Act that are going to be affected here upcoming.
Okay, good. Thank you, Tom. Thanks for going through again some of the relief items out there that they're looking at or may look at this year. Next, we wanted to cover some these, the Tax Cuts and Jobs Act, again, one of the most comprehensive piece of legislation, in a generation, went through at the end of 2017, started mostly in 2018. But as many of you may recall, that some of the provisions within there were not made permanent. They had a sunset or a short time frame with it just because of some of the budget rules they had with it. And as some of those expire, they're going to need to deal with that. So we're going to cover a couple of them here that Congress is going to have to deal with that have, some of them have some bipartisan support to make changes with it. The others, we'll see what happens to it. But there's three ones that we're going to talk about. The first is one that starts here in 2022. It's the interest expense limitation. 163J is the provision. And one of the changes, though, with it, again, this has been around for a couple of years, but starting here in 2022, the formula that they have, they call this adjusted taxable income, it's 30% of that adjusted taxable income. What you do, though, is used to add back your depreciation and amortization deductions. Again, and the higher that threshold is, the higher the 30% is, the more interest you can deduct. Well, starting in 2022, the depreciation and amortization will not be added back to it. So it's just going to be 30% of your taxable income before the interest deduction, okay? So what that's going to do is it's going to lower that threshold. It's going to have more companies potentially subject to this limitation. We put down here, especially those manufacturers or other businesses that have a high level of depreciation and amortization are probably going to be subject to this interest expense limitation starting in 2022. Just note, if you do have any interest that's disallowed, again, it will carry forward, but again, you'd rather use that interest if you could in the current year than have a carryover with it. So something to be aware of with it. I haven't seen much attention from Congress toward extending or changing that at all at this point. This next one, however, has received some attention from Congress. It's the Section 174 for research expenses, and this has been around for a long time, that those research expenditures that a company has, which again would include some computer software development costs, those costs, the deduction for that is allowed as a current deduction when you incur that. What the change would be starting in 2022 is if you have any of these research expenses, the deduction for that is going to be capitalized, and you're going to amortize that over a 5-year period with a half year in the first year. So you're not going to be able to deduct those currently. So that's going to be a big impact for companies that are spending some either in computer development or developing new products, or manufacturers, whatever it is. A lot of companies have taken advantage of some of the research incentives, but this will be one that they're going to have to get less depreciation. Now, again, This 174 is separate from the R&D tax credit that's out there. That's still available as well, but it's the expenditure that is going to be postponed. Again, Congress has supported the research incentives over the last number of years. You know, not only this deduction, but the research R&D credit. There's a lot of bipartisan support in Congress for that, and there was a major push. You know, Tom talked about this omnibus bill to get this research expenditure to allow the current expensing to be available in 2022, and they really put a you know, sort of full court press on to try to get that included in the this omnibus bill, but that fell apart late in the process. As Tom noted before, the Build Back Better did have some relief for these research expenses, which would postpone this effective date that you'd have to do this, you know, 60-month amortization period. That was going to push it out, I think, to 2025. But again, BBB is not moving forward, so that provision is not in there. Now, if they do move ahead with the BBB bill, my guess is they would put this this reformatted Build Back Better would include this research provision in there. But again, we'll have to see. So I think you'll see throughout 2022, there'll be continued efforts to get this changed and provide for a current deduction for the research expenses and not have you go through the capitalized. But at this time, at least at this point, that's still in there. Another one that, again, a number of you may be familiar with is the bonus depreciation. Again, that was part of the Tax Cuts and Jobs Act. Again, increased it up to 100% for, again, new or used capital, your CapEx items that companies had. What's going to happen, though, is not this year, but starting in 2023, they're going to scale that back. It's going to go from 100% bonus depreciation down to 80% in 2023, then 60% in 2024, and then down to 40% in 2025. So it's going to have sort of a sliding scale going down with that. So anyway, one thing just to keep in mind, any businesses, that if you got some major CapEx additions you're looking at for this year, especially later into 2022, you might want to monitor those additions you're making to make sure you get them in before the end of the year, to make sure you get the 100% bonus instead of you know, having it fall into 2023 when it's only 80%. So again, there could be some effort to have Congress change that, but at this point, haven't seen much activity with it. Again, that doesn't start until 2023. And then there's next one. Here's a couple other items. Again, this is several years down the road, but again, with some of the Tax Cuts and Jobs Act, some of those items were not made permanent, so they have a scheduled change for it. Again, number of individual provisions. The individual tax rates that were cut, you know, the rates were up at 39.6, came down to 37. That's going to phase out. The expanded child credit, the higher standard deduction, that would be go back to what it was back in 2017. For individuals, the alternative minimum tax, they haven't had as much to, many individuals have been subject to the AMT over the last few years because they expanded the exemption, and the starting point for where that exemption is phased out was significantly increased. Those will revert back to the 2017 level. So that'll be quite a change, and you'll see many more taxpayers subject to AMT unless they change that. The SALT deduction, this $10,000 cap, again, they were talking about Congress about maybe putting 80,000 in or whatever. Well, if Congress doesn't come to an agreement by 2026, that $10,000 goes away, and they'll have you know, much more ability to take your state and local tax deduction then. The QBI deduction, again, a lot of businesses have taken advantage of this, pass-through businesses, S-Corp and partnership, that 20% deduction for qualified businesses. That goes away in 2026 again, so that would be a big impact to some closely held businesses. And then the higher estate gift exemption drops back to 2017 levels. So some significant changes again on the horizon here, just to keep an eye on as we get closer to that. Congress is going to have to deal with some of these items. So next slide, again, what's our outlook for it? As Congress is looking at these ones, I think the one that's probably of those three main business ones we talked about, probably this amortization of the research expenses that is going to go to 5 years. I would think that at some point there's just a lot of bipartisan support for that, that they'll find a way, whether it's in some legislation this year or maybe even toward the end of the year, maybe in some lame duck session, that they'll find provision to get this current expensing put back in for 2022. So something to keep an eye on, just because, again, It has a lot of bipartisan support. There's a lot of businesses that are affected with it, so look for that. There could be some other items that could be changed or extended as well. Some individual provisions, some of the energy ones they talked about, but something that we'll keep an eye on with it. This list of these extender items continues to be one to really keep your eye on with it. Okay, next we have our second polling question here with it. Let's go through that. Let's launch that question now. Okay, what tax extender item are you most interested in this year? Okay, we've got 3 choices here, or actually, and then a fourth one is an other. The expensing of the research expenditures that we talked about, the changes in the interest expense, the limitation at 163J, or the 100% bonus depreciation and the phase out of that starts in 2023. Or if there's something else that's out there, some other extender item you have, that's another option for you. So why don't you vote now? We'll take a moment just to go through that poll question here. Any thoughts on this, Tom, as to what you're seeing out there as far as some of these extender items?
Well, I think the key issue really that people need to start to think hard about is really after this year, you really only have, assuming no changes come, you only really have 3 years left, and you sort of revert back to 2017 tax law.
Right.
A lot of that is at an individual level. And,
right.
Of course, you've got income tax changes where the rates go up, and AMT starts to become an issue again. You certainly don't have the SALT cap anymore.
Right.
And then the estate tax exemption.
That's a huge, it goes
really
way,
goes back.
way
So,
back.
a lot of clients have addressed their estate, because of the increase in exemption. But if you haven't, you really only have 3.5 years left to address that, again,
Right.
assuming no other changes.
Right. And one thing to note with those tax changes too, that the corporate tax rate again went from 34 down to 21% in the Tax Cuts and Jobs Act. And one thing with it, I mean, that rate was made permanent, if you will. Again, it could be changed by Congress again at any point. Again, they're proposed last year to change, but it has no scheduled sunset date. So whereas these individual rates they're going to have to do something with in 2026, the corporate rate is set at 21. Again, unless they do get a change with it. Okay, let's see the results on that second polling question here. Look at that. Okay, the R&D expenses, again, folks are looking at that, about 13%. Interest expense limit 24. Bonus depreciation was our winner with it, if you will. 50% are interested in that one. So again, that doesn't start till 2023. So some are planning with it perhaps before the end of the year, and we'll see again if Congress does anything with that. So good. Thank you for your responses on that. It's interesting responses there.
Well,
okay.
The whole depreciation issue is really, obviously it's the bonus is starting to scale down. So I think that's going to be more interest. So let's talk about Secure 2.0 real quick. This is really, I think, got some momentum, and I think that of anything we've talked about so far in terms of potential changes, there's I think there's probably as much support for what we call Secure 2.0 as anything. Bipartisan, right? Backing for legislation to really help U.S. citizens, taxpayers save more for retirement. It's a real. There was an editorial by a congressman from Florida that I read recently that talked about how many Floridians haven't saved enough, and how he really supports this bill to try to boost their retirement savings. So there was a big push over the last several weeks to include this in the omnibus bill, but they really didn't want to open that bill up for tax measures, because once you sort of open that faucet, you turn that faucet on, I think it becomes potentially problematic, because then other tax measures get in, and then you lose some votes and so forth. So there's still proposals they're advancing. There seems again to be a lot of support. incentives for both employers to set up plans and individuals that are participants in plans. I really see this as happening this year. I think it's they can count it. Both parties can count it as a political win. There's just not a lot of controversy around this. I'm sure there are some that don't support it, but overall, it's really a very positive bill. So some of the things in it: expanding coverage, increasing retirement savings. One thing is to increase the required minimum distribution age to up to age 75 from the current 72. And remember, we just increased it not long ago from 7.5. So it continues to go up as Americans live longer. So also in this proposed legislation, super catch-up IRAs. So additional $10,000 for those that are at age 60 or above, they can put into those IRAs, right? So simplification and clarification of retirement plan rules, including reducing, the excise tax on not taking RMD for those over age 72. So that would go from 50 to 25%. No RMD proposed on an account that had a balance of less than or equal to $100,000. So you wouldn't have to take RMDs. You could allow those dollars to continue to grow on a tax-deferred basis. And then actually something new would permit charitable distributions of up to $130,000 out of a qualified retirement plan. So you wouldn't have to just have an IRA anymore to do charitable contributions. It could be out of in this proposal would be out of like a 401k plan. So the other thing that I think is significant that we forget about is currently, a lot of the administrative expenses around setting up these plans for small businesses that are starting a retirement plan. There's tax credits out there for 50% of those expenses, up to somewhere around $5,000, depending on the plan. This proposal would actually double that, so the credit would offset all administrative expenses. It wouldn't be just a 50% limit. So, and that would apply to companies with with 50 or fewer employees. Okay, expansion of auto enrollment option for employees. Employer contributions would be allowed to retirement accounts where the employee, because they had student debt that we're trying to pay down, they weren't contributing. This proposal would allow the employer to contribute to those retirement accounts to help them get a head start on their retirement savings. And then actually spouses of employees that are military veterans would be granted the ability to contribute to a company-sponsored retirement plan as well. So lots of really, really positive changes here. The student debt, really a positive change being proposed. So I do see a lot of support for that. And I do think that we will see this come to fruition this year. I think everyone thought it was going to happen in 2021 and it did not. But I think there's a lot of support for this. So the other thing that we're seeing in some proposals is for companies that sell some of their stock, owners of companies that sell their stock to qualify to sell their stock to an ESOP. There's a provision that only really was allowed for C corporations, that allowed for under Section 1042 a deferral of the tax on the capital gain on the sale of that stock. Now under Secure 2.0, it's easy for me to say, the S corporations would be allowed to, S corporation stockholders would also be eligible for that deferral, as long as the ESOP owns, which is consistent with C Corps, that the ESOP must own 30% of the company stock after the sale in order to qualify for the deferral. So, again, another positive development there for S corporations. And of course, a lot of our clients are S corporations. So keep this in mind, right? This could be coming in Secure 2.0 and could be a significant tax savings to those business owners. And then just a quick mention, the proposed regulations just came out on required minimum distributions. So the regulations from Secure 1.0, 300 pages of rules. We're going to spend the rest of the day reading those, of course. But one of the surprising outcomes is that I think caught people by surprise is these inherited IRAs would be required to take RMDs each year and couldn't necessarily wait until year 10 to get that distribution. If you might remember that, the bill took away the stretch IRA provision and sort of cut that to a 10-year window when you had to distribute all those dollars. So, but the proposed regs are saying these beneficiaries have to take an RMD every year, right? So for inherited IRAs, so you might watch that. Again, it's a proposed regulation right now. So again, bipartisan support, and we don't know, like all of this, we don't know, but we think that there's a lot of support for Secure 2.0. Jim, I want to hit a question here. We got actually, oh, look at that. We've got another poll question. This is actually Illinois versus Wisconsin, and there's Frank Kaminsky. So what's our next poll question, Jim?
That's good here. And we got the infamous little Valentine tree with it's got a couple of Big Ten teams on there if you look real closely on it. Some of the ornament buttons there.
Yeah,
okay.
Very nice.
Let's see, what's our next poll question is. Again, it looks like it's a basketball theme. Who's going to win the Big Ten Conference men's basketball tournament this week? Starting actually tipping off as we had that opening tip. The tip-off is later today. Your choice is Wisconsin, Illinois, Purdue, and Iowa, and then other. And actually, with our poll question, we only get 5 responses, so we couldn't get all the teams on here. So we just put those down there. So if your selection is, again, not listed, again, just go to the other here. We'll get our votes here. Before we get to the poll results, so take your time to do that question now. One thing just to note with the Tom went through the Secure with a good overview of that is, again, there's bipartisan support for that Secure. The House and Senate are both been working on, sort of separate bills. There's a lot of similarities to each of their bills, but they're not necessarily identical. So as they might relaunch that, make sure you look at them real carefully if there's a specific provision you're going to follow to see, if it ends up in the final bill that they may move, so it might be in the House version, but not the Senate or vice versa. So that 1042 that Tom talked about, again, I think was in one of the, I think was maybe in the House, but not in the Senate or whatever. So just keep an eye on that. Again, they may add some other changes to it, change the effective dates with it, but something definitely to keep an eye on this year, because we think that could move at some point. Again, it almost made it in the omnibus this week, but it will probably move at some point this year, or maybe in the lame duck session at the end of the year. Okay, let's see our poll question results here. We got that. Oh, Wisconsin, we got 40%.
What?
That's good, Tom. Did you vote for that? There we go. Illinois and Purdue about the same, about 20. Iowa down at 6%. And other, we've got some other, maybe Michigan State, Ohio State in that other group down there. So.
Yeah. Well, there's unfortunately, there's Wisconsin must have stuffed the ballot box again. So I don't
could
know.
Could be. Yeah, I'll have to say that.
Hey, Jim, I want to get to this one question. I know we're kind of running out of time, but somebody asked any deadline to apply for possible ERC credits that were accrued to an organization for 2020 and 2021. And it seems to me that the statute of limitation on those amended payroll tax returns would sort of be the what to look to. Is that your understanding?
Yeah, there's a statute with it. So if you do go back and find out that you were eligible for the employee retention credit, we have a slide here coming up on that in a moment here, but if you do find out you're eligible for that, you've got, generally it's a 3-year period to go back to look at it. So if you've got 2021, you've got, time to go back and do that. One thing to note though is not only when you go back in and file for that 941X is the form that you file for to get that refund claim for your employee retention credit, you'll also need to go back, and since those wages were incurred in 2021, to adjust your company return, whether it's a partnership or a C Corp or S Corp, you'd have to change it and amend those returns because, again, while you're getting that retention credit, those wages expenses are not deductible with it. So you're going to have a change in your tax return for that. So just be aware of that. But you do have at least a couple of years with which to go and do those 941X filings. So good question.
Yeah. Okay. Jim, let's jump into, we got a couple minutes left here and we got a handful of items. Talk about LIFO. We got four topics here. Why don't you take LIFO inventory? Let's talk about that.
Okay, LIFO. Again, the reason we're highlighting this is not that there's any tax change that was made recently or this year or proposal or whatever. LIFO's been around for a long, long time, but it has more of an impact this year. As many as you know, again, not only do we get higher prices of gas going up at record levels now, but many other products from supply chain issues. Again, even before this conflict and war in the Ukraine, we've had supply chain issues, product shortages, tariffs, causing inflation in a number of products with it. And anytime you see higher products, the one thing you should think about from a business standpoint is if you're a manufacturer or distributor, is LIFO. Because what LIFO does is it takes those higher current costs, and those get to be expensed, and some of your, in effect, your older prior costs stay on the balance sheet with it, and it does provide a significant benefit. Again, the higher the inflation, the greater the benefit you're going to get with LIFO with it. And what you end up putting on your financial statement, if you see it, is what they call a LIFO reserve, and that's the difference between the FIFO, which is sort of your current cost, and LIFO, which is the older cost, and that number can grow over time. And LIFO can provide not only a current benefit, but that benefit can grow over time. Even if you don't get as much inflation in the future, you can still have it. It's not just a 1 year deferral you get. It can continue on for a number of years with it. So anyway, again, as prices going up, time to evaluate and look at LIFO. Again, you can still adopt LIFO for the 2021 year if you want to. Again, one thing to keep in mind though with LIFO, it's one of the few areas in the tax law that if you use LIFO for tax purposes, you also have to use it for book purposes. So that's something that you'll need to do, is you have to get your financial statements on LIFO. But again, it can provide some significant tax savings for it. And we've had a number of companies that are looking at it or exploring it. There's a lot of things to do with it, but now's the time to do it. You can't go back and get prior year's inflation. You can only get the current year and going forward with it. So something to keep an eye on is with LIFO here.
Good.
Tom.
You want to? Yeah, I'll talk about. I was just wondering, Jim, do you think the last in, first out method applies to the last team to arrive at the Big Ten tournament? I mean, if that would happen to be the Badgers, they'd be the last one to arrive. They might be the first ones out. I mean, that's a tragedy to the audience here. That 40% voters, but. ERC is maybe we're all tired of talking about it, but there's still a lot of opportunity with it. Somebody asked a question about, when do we still have time? Yes, you have time. We're still working a lot with ERC claims. I think the profession in general. I won't go through all these rules again, but just know that. There's this process you go through if you've had decline in receipts or shutdown, and depending on the year we're talking about, there can be significant refund claims filed on those 1041Xs. So please look at your at a minimum look at your gross receipts, quarterly gross receipts over the last 3 years, 19, 20, and 21. Sit down with your advisor and go through those to see if there's potentially an opportunity. There's still an opportunity there to potentially get some refund claims on ERC. So,
yeah, we had a couple questions, Tom, on the ERC that came through when you were going through that there. One is question was they've heard that if you filed the claim with it, and that kind of deals with this next slide too about the IRS backlog.
Yeah.
How long is it going to take for that?
Mm-hmm.
And because they've had a number of claims that have been filed with it. Again, part of it just because they changed the rules, right during the start of 2021 here, and as folks found out that they were available for that, in addition to their PPP loan, they started filing with it, and so the claims some have taken. We're hearing some folk that maybe filed last fall or this summer have started to get some of those paid, but it's probably a 6 month or longer time horizon with it. I did see a statistic the other day that kind of showed the backlog of tax returns that the IRS is processing. And with the 941Xs, it was about 400,000 claims that they had out there. And again, I would say that the vast majority of those, Tom, would be ERC claims, the refund claims that people have filed. I mean, you could file a 941X for any item, but I would think most of those probably relate to ERC claims. And even as they whittle that number down, there's going to be more claims coming in as people realize that they potentially, are available or entitled and eligible for this retention credit.
Any paper filing is just a backlog, right? I mean, there's still some 2020 returns that we're pretty sure that were paper filed that have not been looked at yet. So, a couple other things. Go ahead, Jim.
I was just going to mention one other question that came up on the ERC. If you go back to the slide before there, here it is, the other slide here. What the general requirements are. And again, as Tom mentioned, you need to look at your gross receipts as a key part of it with it. And again, if you're a nonprofit company or organization, you can qualify for the employee retention credit. Just be aware of that. And again, they do have specific rules on how you measure gross receipts for it. So you can still qualify for that there. And then obviously you've got your number of employees, that if you're a smaller size employer, you're going to meet that rule, and then you just go and calculate your credit from there. So
and the other one I didn't mention is the startup businesses. If you started a business after February 15 of 2020, that third and fourth quarter of 21, you might qualify if you meet the criteria. Got to be a smaller business under $1 million in revenue annualized, and so for startup, we're seeing a lot of those as well. So take a look at this. We got a lot of content out there on this. But just know that there's potentially an opportunity, and unfortunately, it might take 6 months to a year to actually get a check in your hand. But that's not that doesn't mean it's not worth looking at. So let's go to the IRS backlog, Jim, and talk a little bit about that.
Yeah, we just talked on that. Well, we'll just finish up here quickly. Here is again, there's a big IRS backlog. So if you did file some paper returns back in 2020, they are still working on them. They've got $5 to $6 million. There's 6 million returns they're still looking at, and also some of these 941Xs that they have, plus a lot of correspondence. The IRS at least announced that they're not going to send notices out until they process all the backlog they have now. So,
right.
And then last one, Tom, why don't you go through just some of these state taxing, just something for people to be aware of.
So the interesting thing, several states, it's over 20 now, have implemented this workaround where the pass-through entities can pay that state tax at the entity level and get a federal deduction for it, right? And it's called, you might see PTE as an acronym. You see pass-through entity election. Illinois has done it. Wisconsin has as well. But Indiana has not. Our state of Indiana has not. The interesting thing here is, of course, if you're a W-2 employee of a business, you won't get any tax benefit. But if you're a pass-through owner of a partnership or an S corp or an LLC, you will, right? You will get a benefit if you make that election and you're in a state, your business in a state. Multi-state businesses, right, that operate in several states, which have partners or owners in several states, much more complicated calculation. And I think the other thing to note is, the SALT deduction, the SALT limit goes away in 3.5 years. So it'll be interesting to watch what happens, but just be aware. And I think more and more states are probably still looking at this, still could enact a law even with the potential sunset of this limitation coming in at the end of 2025. So, you know, it's a good strategy. We've implemented it for a lot of clients. You know, be aware of what your state's rules are, and if you're a multi-state filer, then you have to kind of go through that and really analyze the impact. So anyway, so with that, I think we're at time here. And so, Jim, any final you know, anybody from Washington call you while we were texting or something, while to give us the latest and greatest update?
Yeah. And as you mentioned earlier, Tom, yeah, this omnibus bill, this again will allow the government to continue. I think the House is going to vote this morning on it, and then they've got another meeting that they're going to leave for a couple days, and the Senate will pick it up by Friday. It may go over the weekend, but they probably will get that omnibus finalized in the next several days, as Tom said. But again, as Tom said, that there was hope to have some tax items in there. There were not. But as we covered here this morning, you'll see that a number of those tax provisions that perhaps didn't end up in that omnibus, you know, may end up in other legislation perhaps later in the year. And again, last year there was talk about a lot of the legislation that was sort of top of mind in Congress. It did not happen, but I think there still may be some changes this year. That's why we wanted to cover a number of these items here. So we'll keep you posted on it. Again, things can change quickly in Washington, and we'll keep you up to date with not only articles, but we'll have sessions with it. And again, feel free to reach out to us if you have any questions.
Thank you, Jim, and good luck to the Badgers and to the Fighting Illini and all of those other teams represented today in our audience. Appreciate your joining us, and please look for that survey right after we finish here, and look forward to seeing you next time. Have a great day.
Good. Thank you. Bye-bye. Thanks.